morning, everyone. Morning, dear panelists. So I'd like to start with a very brief round of intros. So Alioune here with Lofting Capital, early stage VC, Pan-African. The floor is yours, my dear panelists. I think we'll start with Ayanda.
Hi, everyone. My name is Ayanda Bolani from Knife Capital, a VC fund that's based in South Africa, looking at investing in innovation-driven businesses in the Series A, Series B stage. It's good to be here.
Hello, everyone. I'm Max Cohen, managing partner of Y Ventures. We are a frontier technology venture fund investing globally in emerging markets.
Good morning, Walid Belara from Endeavor, Tunisia. We actually cover both Tunisia and Algeria. Endeavor is an organization supporting scale-ups and investing in scale-ups globally in 40 markets. So typically, we select Endeavor entrepreneurs and invest in them typically beyond the Series A. So Series A, B, and C, that's the typical timing of when Endeavor gets in with the Catalyst Fund. But the DNA of Endeavor is an organization of, by, and for entrepreneurs. So we are first about support. We do not invest in all companies that, we don't necessarily invest in all scale-ups that we select. But we do invest in some of them based on the preset rules that we have with Catalyst.
Hi everyone. My name is Hamid Masri, partner at Silicon Badia. Silicon Badia is a Series A fund. We invest across the Arab world, mostly focusing on Jordan, Egypt, Tunisia, Morocco, and Lebanon. And previously, I was a venture builder and an ex-founder. Good to be here.
Thank you very much to all of you. I think we're quite lucky on this panel to have local and global experience when it comes to exit, and that's where we're going to focus our discussion today. I want to first understand, I think, from the last two of this panel, so Hamid and Walid. You both have experience, I think, within the major exits of the region, both InstaDeep and Expensia. I think it's helpful for our audience of VCs, of founders, but also of ecosystem enablers to understand and try to draw some parallels between these two exits. So, first question, why did it happen in Tunisia?
So yes, indeed, we selected both Expensia and InstaDeep back in 2018. Invested in the Series A of InstaDeep around May 2019, and so if the parallel the first one that I see between these two companies, these are Tunisian-born scale-ups disrupting an industry in a market that is either European or global. And when you're doing that, you're going to have much more, I think, exposure to interest and exits because you're disrupting a big industry and in markets that has a lot of activity and dynamics. So that's the first layer. Then we can look at it from other perspectives, but I can also, I don't want to monopolize the conversation. So do you want to?
Sure. Thanks, Walid. Actually, you said a lot of the points that I think I was going to cover on Expensia, but what I'll add is, you know, for Expensia at least, the spend management, the spend management sector was seeing a lot of consolidation. So it took the right team to kind of build the right product there. And when you take the tech team of Expensia and you look at the individuals in it and the output that these guys were producing, they were competing with the best globally at, I would say, potentially a lower cost per unit, let's say. So they had a very big competitive advantage. The product obviously is very, very solid, and you know, they had a huge market share in Europe. So it made them a very, very attractive acquisition target for many companies.
So, Max, from a US investor perspective, I think what came up of the start of the conversation is that startups need to build global products. Do you see? Do you expect your exits when you will invest in this market, not necessarily only in Tunisia, but from the continent? Is startups and founders building local products, but for the world, a key criteria for you?
Thanks, great question. Well, scalability is obviously a huge component for any LP and investor. As much as our investors are focused on impact investing, companies need to have a clear path to exitability. And as much as, like I said, our investors love having an impact, a positive impact on the world and especially emerging regions, the one thing investors want is returns. So we have to invest in companies that we see a clear path to returns and big multiples and big X's, and then everyone wins. So the answer to your question is absolutely yes, it's something we do focus on.
But that's an interesting point because, so I know that, I mean, Knife has one of the best track record on the continent when it comes to exit. I think you've had your fair share of exits within the continent as well. So how do you view that? And does that come with a discount, essentially, on a multiple basis?
Cool, thanks for the question. I think what made Knife have a lot of exits is the approach, the investment approach. So our investment approach is centered around 4 principles. So being find, make, grow, and realize. So find is finding good businesses with great potential. Making is obviously making the investment at the right price. And then growing is obviously being with the entrepreneurs in that journey to exit, which is the realize. So when we make an investment, we think about the exit at the start of that investment. And thinking about the exit is a critical component of our investment process and investment decision. So what we do is we look at where the company is today, understand the players in the market, understand who the company could be bought by, and what the company needs to look like at the point of acquisition, and basically support the companies during that whole process through active engagement, through monitoring of that whole journey. So for us it's very important and it's a critical component of our investment decision at the time of investment.
So the others, I think we're touching on something very important here, which is the role of the investor in order to engineer the exits, especially on this part of the world where exits are not granted. So how do you go about that? And from your perspective, how do you build these exits?
Thank you. So yeah, look, I think it's a good question, and I think it comes down to fundamentals. So I think if you're trying to engineer an exit, but you don't have the right metrics on a unit economics level, on a on a size of market level, you're going to have a really, really hard time. So as Ayanda was saying, it's all kind of baked into the investment process. The way we screen for companies and the way we select companies is really doing half the job for us. And then at the board level, of course, so at Silicon Badia, we're an active investor. We take a board seat. We generally try to direct the conversation in a way that makes an exit a bit more possible. We kind of nudge the founders at the right time to start thinking about an exit, and not prematurely either. So for us, it's very critical that we ride our winners to the best of our abilities. So we don't want to exit too early. But then, depending on the board composition, you might have different. You might have different incentives for different shareholders. Some people come in too early, some people come in too late. So it's important to kind of direct that conversation properly.
So from our perspective, Endeavor is an organization that is always on the same side of the table as entrepreneurs. So we are really here to support entrepreneurs and follow. We are really aligned in terms of agendas with the entrepreneur, and that is always the case throughout the path we are in with the entrepreneurs. So it's not necessarily about it's not necessarily about engineering, but it's more about given the network effect and our connection with over 200 large institutional funds globally. And also the network of entrepreneurs. We leverage that network to make M&A or exits happen, leveraging the network of VCs or network of entrepreneurs. So we are more of a facilitator than in the driver's seat, obviously, but yeah.
Interesting. I think we're starting to touch on an interesting point. You mentioned M&A. I think we're talking about trade sales here essentially, because most of the exits on the continent are coming from strategic acquisitions. How do we go from there to build other paths to exits? And I think I want to hear from you, Max, here. I mean, IPO is probably a long route, but another obvious one, right, is bridging the capital gap, I would say, and being able to, from a VC perspective, to push some companies to our PE folks. How do we make that happen?
Another great question. A hard question. Thanks for asking me that question. I'll actually defer to Hamed for a more intelligent answer. But as a VC, our options are limited. So either to PE or to some sort of strategic acquisition or to IPO. Traditionally, Hamed made the point that VCs used to exit upon IPO almost indiscriminately in the past, and it's become much more optional to follow that company through the IPO and exit at a later date. So I'm kind of answering your question from a VC perspective, but the big change that we've instituted and implemented in our fund is the ability to stay on board past IPO. I think that's the biggest change that answers your question from a VC perspective, and that's the perspective I bring. So I'll defer to you.
Max, thank you first of all for the compliment and for deferring a very difficult question to me. So I think, Alioune, for us, just looking at the PE option is not always sufficient for us. So obviously it's a great kind of it's a great route for the next level for where the startup is going. But typically PEs do growth capital, and we don't have a lot of buyout funds in the region to come in and do secondaries. So for us, really, we're always positioning our companies to have a PE plus a strategic in how they think about their exits. So most recently, our exit from Expensia, it actually included a strategic sale, right? But that strategic sale was also backed by a PE. So the company that acquired Expensia and Medius is actually PE backed, and those PEs are leading the conversation at the board level and structuring these transactions. So really for us, if it's just a pure play PE, it's great. It's more capital for the company to continue growing, but we would still have to think about the secondaries. As you know, in our region, I mean, short of listing on one of the more established exchanges in the US and Europe, we really don't have much of an IPO market, right? So we don't have the liquidity, we don't have the capital markets depth. We're trying to develop that in parallel to enhancing our strategic relationships with companies in sectors we invest in.
Walid, maybe you want to touch on that. Is Africa doomed for IPOs?
I think the fact that we are going through difficult times in terms of for venture in general, it brings up opportunities at every level, because you have like M&A opportunities at every level, because you have startups that are gonna do well and have good unit economics, including in tough times, and then you have startups that are gonna suffer even more during these tough times. So at the end of the day, this situation of extremes is actually a catalyst of M&A activity. So one other portfolio company or endeavor entrepreneur that we are supporting and invested in is Yassir Noordin Taibi, CEO. And Noordin and Yassir raised a round of the largest fundraising round in North Africa of 150 million, like in recent years, Series B in recent years, and it was in November 2022. So it was really at a tough time, and they were able to make that happen because they have really good unit economics. And actually, that might happen again because they still have those good unit economics. And what's happening is because that they have that advantage in the current market, what they did is they strategically decided to expand into the French market, which like going the opposite way, and they actually acquired a startup called Flink in Europe. So they're using the current situation as an opportunity. So it goes both way, including for startups coming out of Africa. So I think the most important thing is, like, as long as you're building a very sound business with good unit economics, tough times will always happen, and you can use those tough times to your advantage.
I like that you mentioned the name, because we're bringing it back to people. So a question from all of you, but I'll probably start with Ayanda. How do you align the interests and manage the conversation with founders when it comes to exits?
That's a great question, and it's a question that we ask ourselves all the time. If you look at our website and our branding and our philosophy, you'll see that we're an exit-centric business, which means that we support entrepreneurs to exit or build a business for exit. So we've gotten a lot of flack for that. There's a lot of criticisms for that. There's some comments around the fact that building a business to exit, you're not focusing on the fundamentals, but you're actually just focusing to sell. But what we encourage entrepreneurs is to actually focus on building good, sustainable businesses. And those good, sustainable businesses will actually attract buyers. Another reason why we support, I guess, exits is because if you look at our business model as a venture capital fund, we need to return money back to our LPs. And for that, we need to exit our businesses or the investments that we've made. So how we try and align with the entrepreneurs is to be quite transparent in the initial conversations and let them know that this is the venture capital business model and try and understand whether it aligns with their interests. And if they are on board, then we agree on a plan in terms of what we think a potential buyer would want to see. And we work on that plan on a very regular basis. But there are options for the founder to stay in the business. So we've actually had an exit where I think the company is called FlightScope. It was a management buyout. So we managed to exit the business through that, but the founders stayed invested in the business. So there are different avenues for the entrepreneurs, but I think for us it's to be very transparent upfront, but also just to encourage the entrepreneurs to build good businesses, because if you build a good business, you will attract a strategic buyer. And if they offer the right price, then you need to be prepared for that. So building a good business and thinking about the exit in mind at the initial investment decision optimizes for that day, because it might come. And also there might be situations where the entrepreneur also needs to exit because of certain lifestyle changes, maybe the market has changed. So we encourage entrepreneurs to be open-minded and think about such events and actually optimize for such events.
How angry with me will you be if I jump back to a previous question? So I just wanted to address quickly as a foreign investor or management company for foreign investors, that if I thought Africa was doomed, I wouldn't be here, right? It's simple as that. So I don't want anyone in this room to think Africa is doomed in any way. In fact, quite the opposite. Are there a lot of challenges? Yeah, lots. Can we overcome those challenges? Yeah, that's why we're here. Now you can ask the hard question. I knew you had something on the tip of your tongue.
No, I mean it's definitely a great point. I want to take the conversation towards exit routes. I think we've been historically, at least in Africa, looking at Europe and the US for exit path. Do you see an up and coming diversification in terms of buyers? Do you see, I don't know, Asian strategics? Do you see strategies from the MEA region coming more and more? And how can we help bridge those gaps?
So I think that's a great question. So look, I mean, before I answer that, maybe just going back very quickly, just to remind everybody that for founders, this is an incredibly difficult journey. You know, they spend years building their companies in extreme ambiguity. You know, just even if they're not doing a frontier technology like AI, it's incredibly difficult to build a prototype that then gains traction, gets revenues. Meanwhile, they're upping their game in terms of running a business. And it's incredibly difficult also to keep convincing everybody on your team that that ESOP that they've kind of signed up to is going to be worth something. So I think, you know, 5, 7, 8 years down the line, many people are going to be aligned towards an exit. And maybe now towards the question you just asked, Alyun. So I think, you know, when we look at North Africa, specifically, you know, bigger markets like Egypt, and we look at, you know, the MENA region or the Middle East vis-a-vis the GCC, Saudi Arabia, and the UAE, those are obviously very attractive markets for any startup in the region. There are always challenges entering new markets. I think anybody who thinks we are in one unified market or two is very mistaken. I think we're in 25, 30 different markets, so there's a lot of nuances on how to enter and how to speak the language, so to speak. So I do think it's difficult, but I do think that it's it is a possibility, and it's an increasingly attractive possibility. I would say though that since IPO markets remain to be challenging in the region, there's a big reckoning around how we kind of consider valuations, right? So, in the VC world, especially on the earlier stages, we might look at companies and their inherent worth in a very different light than, say, a larger corporate that might just look at dividends and might look at margins and might value the company using different methodologies than some of the earlier stage methods that we use. So I think there's a big conversation to be had about that, and I think there will be a middle ground in the coming year or two where you'll see a lot more compromise from both the buyer and the seller to get to a point where they can do a transaction, because at the end of the day it's still demand and supply and negotiations, although we do live in an ecosystem where there's a lot of encouragement and there's a lot of kind of trust, but at the end of the day shareholders and boards of directors are going to really be the ones moving that conversation.
So one thing to take into consideration when talking about these exits is in Africa we have very different dynamics. So some markets are small and automatically looking outside to Europe, the US, Tunisia is an example, very quickly. So startups are really, for many of them, are building products from the get-go. They are thinking Europe and the US because they cannot listen. Like it's hard unless you're in a very specific larger industry. It's hard to grow very big in Tunisia and in North Africa in general. So that is not the case when it's not that true when you're thinking Egypt, Nigeria, South Africa, Kenya. So that creates an automatically different dynamic, and that needs to be taken into consideration as well. And that's probably why you've seen the expansions, the tip of the word, exiting from Tunisia to Europe. You also have, going back to the example of Yassir, you can also be in a situation where you build a regional leader in a relatively big industry, and that's then a different case scenario. You're not necessarily servicing European market from the beginning, but you're building a regional player in a big industry, including getting into super app and fintech. So you automatically are gonna attract attention from investors and exits later. And you also have like natural ties. So our natural ties from Tunisia, Algeria, Morocco are more looking towards Europe and France, for instance, but not only. We are less connected to the GCC, although that, like relative to Egypt, for instance, right? Jordan, Lebanon, etc. But that kind of not disconnect, but yeah. So that connection is getting now built because you have a lot of mobility, a lot of interest from GCC, and these exits that we're talking about also are raising interest from many regions in the world.
I think you're taking the conversation in an interesting direction, because we also have large companies across the African continent. We also have potential companies that could provide us this exit path from a trade sale perspective. Have large banks, have large telcos, but not only. But we've not seen exits on that direction. What is missing for this to happen? Whoever wants to take the question.
Yeah, I'll take it. This is something I've talked about all week, and it includes a number of things. So economies of scale, scalability, absolute necessity, an ecosystem in which foreign investors can thrive and succeed, because the only way I get paid is upon exit, IPO, acquisition, some sort of liquidity event. And unless there's a structure to accommodate that, a clear path, it's very difficult to make the, I'm representing other people's money, and other people are trusting me with those decisions. So I have to make sure I've done all my homework, and that pathway is clear, not only from a market perspective and an economic perspective, but also political and legal. So all of these things factor in majorly. Like you said, Walid, right now let me just address the elephant in the room, if I may. But I don't mean this to be offensive in any way, but the exitability factor is greatly influenced by structures that limit companies from growing beyond the place where I need them as a VC to grow, right? So they're in a small fish tank, right? They need a larger fish tank. Right now, that larger fish tank is Dubai, Europe, Delaware, right? So we're having to take these companies out of the ecosystem where they're seated, and the innovation where it's, where they're bred and raised, and take them to other markets. So that's part of the issue. When I spoke previously about the challenges, that's a challenge. But here's the good news. In countries like Tunisia, we have the Startup Act. You have the Startup Act. And thank you for the Startup Act. So Senegal, same thing. So I'm a foreign investor coming to Africa. I'm traveling around Africa. I'm meeting people face to face. I'm thankful to Africa Arena, for having these types of conferences, not only here, but in other locations in Africa. And it's changing. So there are locations where I feel comfortable going and representing other people's money and saying, yeah, okay, we can make it work here. Like, we can make it work. All the pieces are here. The innovation is absolutely here. The education, absolutely here, no question. There are several countries where the structure is changing to the benefit of foreign investment. Okay? So we are getting there, and again, I wouldn't be here if I didn't see massive, massive potential. And just so you know, for our fund, our venture fund, a 3x return is a loss. That's horrible. I'm getting fired for that by my investors. A 5x return is like, not even worth getting out of bed. A 10x is okay. A 10x is okay. So we do have to have large X's, but the value I get investing in companies in Africa is multiples of magnitude greater than a company I invested in Silicon Valley or Austin, Texas, or Washington, D.C. So I don't need 1,000x returns, right? I don't need that. Nominal returns comparatively to the US are great for me because of the value I'm getting up front. Make sense? So, thanks.
I think we need to move to Q&A, please, Ayun.
More than fine. Perfect timing. But I like what you said around price discipline. Definitely that we need to impose ourselves. Also, investors, it's conversation that tend to be not easy with founders, but definitely necessary. Any question in the audience? Don't be shy. Who wants to start?
Any other questions? So we can know if you are taking 2, 3.
Hello, my name is Dr. Haroun Ounes. I'm a Tunisian entrepreneur and I run an incubator in healthcare technologies. My question is to Mr. Cohen, but also to all the members of the panel. You said you are here because there is a massive potential in Africa and particularly in Tunisia. What are the, let's say, the green flags that you are seeing now and in the 5 or 10 next years that you can say that there is really a massive potential? Thank you so much.
Great question. Thank you.
Maybe, Max, if you allow us, we take the 2 other questions, and then we, since his question was to you, but also to the panelists, maybe we'll have a last round of the panel answering the 3
Perfect.
questions. There you go.
Thank you all for the great talk. I wanted to go back to the structural endeavors and the advantages that Tunisia and the other big 4 countries have in Africa, and how could we keep improving that, and what are the next milestones to get as governments and institutions can help getting to exits?
Thank you. Okay, there is another one here.
Hello everyone, I'm Ghassan, CEO and co-founder of startup BMove. We connect parking to mobility. My question is, being a pre-seed startup, I'm really interested to know what you think about the common success factors for the pre-seed startups, which I think you joined the journey on a later stage on Series A to C. What are the success factors in common that you give as an advice to pre-seed and seed startups? Thank you.
Thank you. I think that's it. So I can.
Thank you. So I'll take the first question. So the green flags, there's several green flags, especially in Tunisia. The first green flags I look for personally are incredible innovation. Tunisia definitely checks that box. Standard of education, Tunisia definitely checks that box. And opportunity. And opportunity means, again, a structure, a setup, a legal paradigm that allows to flourish. So those are the initial green flags. I think one green flag that many people miss is education. So there are places that have incredible innovation, but the standards of education are challenging. That's not the case here in Tunisia. It really has one of the highest standards of education anywhere. So again, those are the initial green flags. There's obviously a lot of other green flags, but in order for me to even consider coming to a location and scoping it out, those are the green flags I look for. Fair? Thank you.
All right. I think the second question was more about what should we do in Tunisia to move even faster towards exits and being more entrepreneur friendly, or being more VC also and entrepreneurship friendly. So I'm gonna echo what our scale-up entrepreneurs have said in the past, including Kerim Gir, but not only. So I think, so their ask at multiple occasions were international talent mobility, and the fact that it is hard for a foreigner to work in Tunisia is a really big problem, because if you are not able to attract international talent to Tunisia, so you're giving another reason for local talent to leave, because the good talent is attracted by great leaders, and one of the ways to keep the great talent in Tunisia is to bring international great leaders to Tunisia. And I'm not saying that local talent should not go abroad. Like almost every one of our big successes is an entrepreneur from the diaspora. So they went out, they came back, kind of, and then they built these huge successes. The second thing, quick win, is more facilitate currency exchange. So that's another ask that came from our scale-up entrepreneurs. So if you're gonna have a hard time getting hard currency in and out, especially out of Tunisia, so that's gonna be still a big problem for entrepreneurs who wants to expand regionally and why not globally. So these are two big things, and I would add to that overall, like the legal framework, we should start thinking ahead and look at what's happening in other countries where the legal framework is much more entrepreneurship friendly, and basically copy it and make sure that our lawyers and legal people are trained to that different legal framework as soon as possible.
Well, so I'm happy to take the last question around advice to pre-seed founders. So we typically invest in the Series A stage, and the advice that we'd like to give to seed founders is to think about what Series A investors would like to see once you do graduate to that phase. So one would be a strong cap table, so making sure that you as the founder have significant equity in the business, because we want to invest in a company where we believe that the founders have a strong reason to care, and because we're aligned with you and we basically backing you. So we immediately get afraid when we see a cap table or shareholder base where the founders don't own enough equity in the business, because as you raise more equity, you will dilute, and therefore the reason to care will dilute even further. I think focus on your fundamentals. So at the Series A stage, we'd like to see businesses that have strong unit economics. So focus on building a great product with strong unit economics, solving a great problem. And then in terms of governance, I think it's a very unfair statement to say, but Africa has that perception from the international markets that it is corrupt. And it's a very unfair statement to say because corruption happens everywhere. So just ensure that your governance processes are in check. Make sure that your ESG boxes are all ticked, because that's also where the world is heading in terms of that direction. And we like to invest in scalable businesses. So we understand that at that point you maybe aren't generating a profit, but would like to see that path to sustainability, and like to see your business actually scale. So I think that's the points for me.
Yeah, just maybe more on this as well, especially if you're in the pre-seed stage. I think it's very important to focus on getting an MVP out very quickly and focusing on achieving a product market fit. It's the holy grail, right? So it's very difficult to say, oh, I have product market fit. But I mean, there are many leading indicators that show your traction. Really get obsessed with your customers, really understand what the pain point is, and also know that you're probably going to pivot 2, 3, 4 times before you actually land on this product market fit. Don't be afraid. So I'm speaking as, in my capacity as an ex-founder and all the lessons that I've learned, succeeding and failing actually in that. We also look at cash efficiency, right? So how much money did you have to raise in order to get to a certain level of recurring revenues, if that's the business model. So again, focus on product market fit. The only way you do that is to get obsessed with your customers.
So you don't have your mic? A micless moderator. Can you give him the... Thank you, Walid. Tunisians always.
Where's the gold mic? Please.
I told you you'll get used to it, Alioun.
Yeah, definitely. Has its effects. But no, I mean, just thank you, everyone. I think definitely key takeaway here is to exits are built, and the only exits that will happen and come from the continent will be from strong companies. So we need to, as an ecosystem, help build sustainable businesses that have the potential to go global. And of course, I love the point that you touched on, Ayanda, one governance. As an ecosystem, that's something that we need to prioritize, coming from a perception point of view or whatsoever. So yeah, if I have a call to action from this panel and to the audience, is to definitely work together around building these governance frameworks and building these bridges from Africa to the world. Thank you very much, everyone.
Thank you, panelists.